Hi, everyone. This is Suzanne Nelson in HR. Thank you for attending the webinar. On the call with me today, I have Bud Green, who is our financial analyst, and he is going to talk today about the Roth contribution that we are adding to our 401k plan. So I'm going to go ahead and give it over to Bud and let him go through the program for us.
Okay, good afternoon, everyone. So obviously, we get a lot of questions about the Roth contribution issue, and we think it's great that ALTOUR is adding it to the plan. But it is a little bit of a decision-making process. And one thing, just as a spoiler alert, the answer is not always that straightforward as to whether you should do a Roth contribution or not. So I'm going to take 15 minutes or so here and kind of take you through the mechanics and the pros and cons of doing it, and hopefully it'll make it easy for you to decide whether this is something you're going to do. So if we can go to the first slide, let's start with just a general concept here, because a lot of times I get phone calls from people thinking that the Roth and the 401k are different plans or what have you, but you have overall contribution limits to the 401k plan of either 18.5 or 24.5 per year, depending on how old you are. And that is whatever percentage of pay it is, it doesn't matter. It's a dollar limit cap. Within this cap, you can split your money up. You can make it all pre-tax or all Roth or a combination of the two or whatever it happens to be. But those are the limits however you get there. So really the topic of this conversation, this seminar is, how do you get to those limits, or how do you split your money up between Roth and pre-tax within those limits? But those are the limits for the plan as a whole, and whether it's a Roth or a pre-tax contribution, it's still going into the same plan, and it's still subject to the overall contribution limits that we see there. Okay, so on the next page, okay, so in the past, the only option that we've had in the plan has been a pre-tax option. So you put the money in, it's a pre-tax contribution, and then the taxes are paid on the time you take them out at retirement. So you get the tax break now, and then you pay the taxes later. And the main advantage of the pre-tax contribution, we'll see in a moment, has to do with the fact that it's a little bit easier on people's budget. Now Roth, again, everything's still going in the plan, but you're paying full taxes on your paycheck, making an after-tax contribution like you would to a credit union or savings account or whatever you would have set up after tax, but you're never paying taxes on the way out. So it's either or. So you can see the big issue here is where do you take the deduction, either now or in the future. So moving to the next page. So let's look at it just mechanically, and this is pretty simple stuff, but this is just an example. Someone making 40 grand a year at a 3% with deferral rate with a bi-weekly payroll and a 25% tax bracket. If they want to put in 3% of their pay at 40 grand, the pre-tax at 25% withholding rate is going to be not $46 out of their paycheck. It's going to be $35 out of their paycheck because of the tax break. In the same way that if you got a 3% raise, your paycheck doesn't go up by 3%, it goes up by the 3% less whatever taxes you're paying. In this case, the taxes you're saving is what makes it easier on your budget. If it's a Roth contribution, it's the full-on $46. So that's what you see coming out of your take-home pay, and you can see the different numbers at different percentages. So the question is, why would you want to have more coming out of your paycheck? And the answer is on the next page. Or actually the answer is a few pages, but we'll look at the next page anyway. So here's my take on it, is that most people in these plans don't necessarily look at a percentage of pay in terms of how much they're going to put in. They may do that with respect to the matching contribution, but usually they're setting a budget. So let's assume that this person, regardless of how much money they're making, they decide they have a budget of $300 out of their take-home pay that can go into the 401k plan on a monthly basis. So in a pre-tax situation, they can put in $400, which gets them to the same $300 because of the tax break. So $300 out of their check, actually 400 going in the plan. For the Roth, it's only 300 bucks because it's after tax, and that's all they can do. So you see that you know, the annual contribution is obviously higher for the pre-tax than it is a Roth because you put in 400 bucks instead of 300 bucks. That's 4,800 versus 3,600. And over time, the value is going to be higher. So at a 6% earnings rate, this one-time $4,800 deposit is now worth 27,000 bucks. On the Roth, the $3,600, 30 years later at 6% is worth 20,676. And assuming the same tax bracket of 25%, you can see that you get to the same point in that you owe taxes on the pre-tax at 25%. You don't owe taxes on the Roth. You end up with the same amount of money given this one constant, which is the 25% tax rate. So it's like wherever you go, there you are. If you move to the next page, we get into the issue though. And the issue here is what's going to happen with tax rates. There's another issue that goes along with it, which is, you know, we do a lot of management and planning for retired people, in that the amount of money that you're claiming as income also affects Medicare premiums. And to a certain extent, if you take Social Security early, it also can claw back some of your Social Security benefit. So there's other issues involved here. But when you get to retirement at age 70, you have to start taking required minimum distributions from your 401k, your IRA money. And we do see some circumstances where people are having to take required minimum distributions that are high enough that's putting their tax bracket in a fairly high level and or getting in the way or bumping up their Medicare premium. So, I mean, I hate to say this term, a good problem to have, but it is sort of a good problem to have. What it means is that we've got people that have saved a ton of money on a pre-tax basis, and as the money comes out of the plan, their effective tax rate maybe isn't lower than when they were working. And it used to be that we would always assume, okay, your tax bracket's going to be higher when you're working than when you retire. But that's not necessarily the case if you've really been a good saver. The other thing is that tax rates, marginal tax rates, although we like to complain about them, they're actually at the lowest level they've been in about 40 years. And I'm not psychic, but I can see our government running massive deficits. And I got to believe at some point tax rates have to adjust to make up for that. I personally don't think we're going to grow our way out of this debt. So you could make a case that in the future tax rates are going to be higher. So the Medicare issue, the tax rate issue, and you can look at this page right here and kind of see where it turns out. You know, in the upper left-hand corner is what we talked about before, which was tax rates stay the same, you end up with the same amount of money. However, if tax rates decrease 10% in retirement, you actually have more money doing a pre-tax contribution, and if they increase 10%, you have better thing doing a Roth contribution. So, you know, we're kind of making a little bit of an arbitrage bet here on where tax rates are going to go. So if you go to the next page. Okay. So here's the question, and we already talked about the tax bracket issue. Here's some important points inside of kind of who uses the Roth. First of all, the company's matching up to the first 6% of your pay. So you've got to get to that level. Otherwise, you're just leaving money behind from the company. So if you need the pre-tax advantage to make it easier on your take-home pay to get to that 6%, then the answer is very simple. You've got to go pre-tax. However, if you don't need that, then it's a little bit different issue. My belief is that people that are closer to retirement, the Roth probably doesn't make a lot of sense because you're probably at your highest tax bracket that you're going to be in for a number of years. People that are early on in their careers, you could, I don't know what's going to be your tax bracket in retirement, but you could make a case that your tax bracket while you're working is going to be higher later. So it might make sense to do a Roth now as opposed to later. Generally, this whole Roth thing makes sense for two groups of people. One is people that are younger, at least 10, 15 years from retirement, and also for people for whom these overall contribution caps are really no big whoop, and they can hit them easily. And so by doing a Roth contribution instead of a pre-tax contribution, it's sort of a backdoor way of ultimately getting more money in your retirement plan because you won't be paying taxes on the way out. So, people say, well, what should I do? My advice is that if you are at least 10 years to 15 years away from retirement and you're not having trouble getting to that 6% level to get the company match, that you consider either doing Roth or splitting your money up, your contribution up, maybe half Roth, half pre-tax. You're going to get the same matching contribution whether you do Roth or pre-tax. It doesn't matter because it's based on your total contribution. But I think, again, if you're younger, you can hit the 6% level. I would be looking at doing Roth or doing a combination of the two. I think it makes some sense. Because I see people in retirement, and most of my clients don't have a big Roth accounts because this thing is fairly new. But the couple that do, it's kind of a nice thing because you don't have the required minimum distribution requirements on Roths. And also the money comes out is completely tax-free, so it's not messing up the Medicare premiums and it's not jacking up the overall tax bracket. So it's sort of a nice thing to do. So that's sort of really where it comes down to, and I wish it was a more cut and dried question. Now, I believe in the plan at some point, if not now, you also theoretically do a Roth conversion where you could take your pre-tax contribution, you can convert it to Roth. Not many people do that, however, because let's say I've got $100,000 in the plan and I want to convert that to a Roth. That means I've got to pay taxes on $100,000 right now. And so that's bumping up my tax bracket. Also, the money can't come from inside the plan. You'd have to have the money outside the plan and pay the taxes on it. That's sort of a dramatic move. It would have to be sort of an interesting situation where someone had a very low tax bracket today and they had a lot of money in the plan and had a lot of money in savings outside to pay the taxes. Those things usually don't go together. That's sort of a unicorn in 401k world. But that's a basic review of really what the issue is. So if you go to the next page, I just want to talk a little bit about IRAs versus 401k contributions on the Roth side. So, because some people will call and say, well, I'm doing a Roth, my broker told me to do a Roth IRA instead of this or whatever, and I won't make any comments about the broker part of that sentence, but a Roth IRA and a Roth 401k, conceptually, it's the same thing. It's the same tax issues. It's the same economics to it. It's just one is done on your own and one is done inside the plan. And so most people are doing it inside the plan as opposed to outside the plan because, A, you can see on the right-hand side, you can see the contribution limits are higher inside the plan. And that has to do with the overall 18.5 and 24.5 contribution. And number two, you've got income limits to do a Roth on the outside. And for some people, this is a little money. For some people, this is a lot of money. But you can't always do it in terms of doing money outside the plan. I don't see the logic of doing it outside the plan. The expenses are typically lower inside the plan, and the limits are higher. And again, tax-wise, it's the exact same issue. So that's sort of my thought on that. But that kind of explains the fact. So, one of the things that I've said in education seminars, I'll say them again, is that my experience is that when the larger number of investment accounts you have out there floating in the world, the higher the likelihood that the whole thing gets disorganized, orphaned, and from an investment standpoint gets very sloppy. And this is just because we're busy, and you end up, well, you leave one company and they got an IRA and the guy at the bank said, hey, move it over here, and the broker said, move it over here, and you end up with all these IRAs. For the most part, to the extent that you can keep your retirement plan money in a 401k plan, wherever you happen to be working, whether it's ALTOUR or the next place or whatever it happens to be, the more you can have this stuff consolidated, the less likely it is that things just get a little bit funky and out of hand out there. So that's my thought on that. So moving to the next page. This is just a little thing about Fidelity Net Benefits, and my only point here is that if you go to Fidelity Net Benefits and log in, get yourself set up, they know who you are, and you can affect all these transactions online, setting your deferral amounts, divvying it up between Roth and pre-tax, setting your investments, or whatever it happens to be. And then on the next page, this is just my information. And you can contact Fidelity, and Fidelity will also help you out with making trades and doing the Roth thing, or whatever it happens to be. If you just want advice about your investments in the plan, or you want me to look at something else that you have going out there, please just give me a call or email me, and I'll walk it through you. What am I trying to say? I'll walk through it with you. We are under contract with ALTOUR. ALTOUR pays my firm a flat fee every year to provide investment advice for anybody who needs it. We're not brokers. We're not earning commissions on your money in the plan, that sort of thing. So if you need help, please give me a ring. Okay. So that is the presentation. I know the next slide just says questions. Suzanne, do we have any questions or anything?
Yeah, we have a few questions that have come in. The first question asks if the deck will be available after the webinar. Yes, we will get this information out to everybody after our call tomorrow. We have another call tomorrow, and then I'll send out the PowerPoint. We're also recording this presentation, so I can send out the recording, or at least a link to where it will be on the intranet, so you all can review the information again if you need to. Next question, if we enroll in a pre-tax 401k to start, could we change over to a Roth 401k later?
Yeah, again, you're enrolling in the 401k plan. It's just one plan, and anytime you want, you can change the contribution you're making around, again, partially Roth, all Roth, pre-tax, whatever you want to do. It's still, the decision tree is how much to put in the plan, how you want to split it up, and you can change that whenever you want, but it is not a separate plan.
And I will let everyone know, beginning on July 2nd, on Monday the 2nd, when you go out to Net Benefits, that's when you'll see the Roth contribution information there. So if you want to enroll into the Roth, you can do that on Net Benefits after July 2nd, and those contributions will go into effect the first payroll in August. And you can make changes to your plan at any time. You can, 1 month do one thing, 1 month go in there and change it again. Just know that the changes take effect the first payroll of the following month. So again, it's not a certain time during the year. You can make changes as often as you like. Next question, can you explain more about the company match of 6%? I'm not sure doing the Roth or staying as is affects that. I've got at least 30 years until I retire unless I win the Powerball. So with the match, go ahead, Bud. You can probably explain it better.
No, you go ahead. You're on it.
Okay. With our match, it's 50% up to 6% of your contribution. So if you put in 6%, we're going to match 3%. If you put in 12%, we're only going to match 3% as well. So it's 50% up to 6%. And that's for Roth and the traditional 401k combined. So they're not separate. Like you said, they're the same. It's the same plan. So we take that amount based on if you're doing one or the other, doesn't matter. And it's 50% up to 6%. Next question, can you, so if you are doing the Roth in plan, the income limits don't apply. We can still get the benefits even if over the married filed income level?
Yes, income limits don't matter inside the plan at all.
Okay. And then the last question I have, can you do the same 6% contribution for the Roth 401k and the pre-tax 6% 401k? No, it's combined.
Right. I mean,
Well,
it's all combined, but yeah.
Yeah.
Yeah,
Okay.
you could do 12% if you want to, as long as you're within those dollar caps.
Correct. Okay, if anyone else has any questions, you can use the chat feature, and we'll hang on here for another minute or two to see if there's any more questions. And again, we recorded this presentation, so I will send that information out tomorrow. All right, I'm not seeing any other questions, so we will go ahead and end this presentation. If you do have questions, you can either email Bud directly, you can contact Fidelity, or you can email us at hr@altour.com. All right, thanks everyone for joining. Thank you, Bud, for going over the Roth information.
Okay, thank you. Bye.